Very warm welcome to all participants on today's Smartkarma Flash webinar, where we will take a closer look at the unfolding developments at the We Company and Softbank Group. As our expert speaker today, we are privileged to have with us Vicki Bryan, CEO of BondAngle, a bond investment research firm. Vicki founded BondAngle in 2017 after more than 20 years in investment management, research and sales with a primary focus on the high yield market. Before BondAngle, she was a senior analyst with more than 10 years with Gimme Credit and previously a partner with AIM Capital Management, now Invesco. Ladies and gentlemen, this is a flash webinar. Please send in your questions throughout the webinar and we will get to them towards the end. Also, as a follow-up to this, Smartkarma will be helping clients who wish to undertake bespoke research requests or standalone assessments to their projects or portfolios. For this, simply contact your Smartkarma sales rep or account managers to discuss this further. Now, without further ado, I'm going to pass it on to Vicki. Vicki, it's great to have you on the call today.
Glad to be here. Thank you.
Now, Vicki, you've been saying for months that SoftBank's rescue plan for WeWork was in trouble. Perhaps, taking into account the events of the last 48 hours, could you sort of recap why that was your view?
Yes, thank you. So just in brief, what's happened in the last day or so is that word has leaked that SoftBank could be possibly trying to pull out of at least part of its rescue plan for WeWork. The part that we're under contention is whether or not they're going to go through with the $3 billion in stock buyback that they had tendered for. And now this comes just 11 days before that tender is due to expire on April 1st. So the question is this gamesmanship? Is this SoftBank trying to get better terms? Because obviously market conditions, as well as, all of our knowledge about how dismal WeWork's condition is, all this, there's this new information. So are they trying to incorporate what's, turning out they bought a bad thing and trying to get out of it altogether? Are they trying to get better terms? What's going on here? So that's where we are. So the clue to this, though, is that there's more than meets the eye, is that you also had a confirmation to me in that Standard & Poor's, Standard & Poor's had, let me shut that down, pardon me. I'm getting Smartkarma alerts, pardon me. SoftBank got a notice from S&P that they were putting their debt on negative watch. And so that's the thing we need to pay attention to, because what's more than meets the eye here is that SoftBank its WeWork infatuation has actually put it into serious trouble with its banks and with its investors. And so that's the theme that's been playing for a while. So getting back to your question, why have I thought this for a while? And it's because it was really starting to come clear back in October. There were a lot of contingencies in the deal that they struck between WeWork and SoftBank. And it took also, by the time the deal was struck, which was late October, this was more than a month after clearly the IPO was pulled, WeWork was hemorrhaging cash, and days, weeks, months were on and still no deal. I took a cue also from WeWork's banks, and WeWork's banks had already been signaling that WeWork is in significantly more trouble than the market realizes. Even when the IPO was announced, you could tell by the bank's dealings that they had priced an excessive risk, much more expensive than their existing terms, and they refused to close any deal unless the IPO closed. And then when they came up with their own bailout package, there was essentially, even more distancing from the banks. They didn't want any exposure. They weren't going to loan any penny themselves, just pretty much collect fees and sell bonds and PIK notes even, but not loan any cash to WeWork. So SoftBank's deal was the only one that actually gives WeWork cash. But immediately, the only cash they were going to get was $1.5 billion. And that they had WeWork SoftBank wired to them immediately. So they were immediately in need of cash, which made sense because I had calculated they were burning $2 to $3 billion a quarter. And I don't think that was really recognized or even worried about because, heck, we got a $9 billion coming in with an IPO and new credit facilities, no worries. Well, there are worries. And they ran out of that cash, as we now know. I thought it was going to be, in a month or so, and it was. They were out before November. So even that, knowing those terms, they wired in immediate cash, but then it was going to be months ahead. The deal was very carefully structured in two key ways. One, SoftBank was very specific in not taking equity control of WeWork. They did not want to consolidate WeWork on, on their trashy financials and expensive obligations onto their balance sheets. Now, I thought it was because SoftBank, or who knows, but SoftBank was trying to distance itself. Now we adding it to other things that we learned later, I suspect is because its banks were already pressuring it at that time. SoftBank was already in with WeWork like $11 billion. They were still trying to value the thing at $8 billion overall as an equity. I had already valued it at 5 to 7 billion back in the summer. And that's when people were just trying to come to terms with maybe it's not worth 47 billion. And by October, it was clear to me it was maybe worth 3 billion as a going concern. And if nothing happened, it was really the equity's worth zero. So this is what SoftBank's dealing with its banks. The second thing is we have emergency cash, but then the tender had to happen first. And then they made a 4-month extension for the tender to play out. Now that's weird because you have a small group of shareholders with WeWork, private shareholders. Everybody knows each other. They've already been talking for a while as the IPO was imploding and probably had a hand in determining the terms of the bailout. So what's here to determine? Why would it take 4 months for this tender to play out? And that was a question. And then they stacked it so that only after the tender was complete, and that would mean that SoftBank would have 80% of control of the company, even if it's not equity control, then they would pursue the bond deals, which would be another 3.3 billion in cash that WeWork needed like as of yesterday. So we know these things. We know that clearly WeWork is burning through cash, sets cash on fire as soon as it gets it, can't wait. And all it has is 1.5 billion, which it's going to run out of in a matter of a month or two, which it did. Two, you get 4 months to pull together a tender offer that really could have maybe been done over a matter of a few weeks at worst. Three, you don't agree to proceed with giving them any more money until these other things are done. And it was those things that bugged me. And then after we get the terms of the deal struck and everybody, yay, they're saved, it's still another month or so. And we realize, or I'm watching, and WeWork can't get its credit facility done. And no banks would do, it's traditional banks led by JP Morgan, Goldman, Morgan Stanley. These are the very banks that had pitched this thing just a year before. It was worth $60 to $100 billion. They were pitching it to investors and to WeWork so that they could win the IPO business. And now, nobody will take their call. So something was really, really well. The banks, I always take cue from the banks because they know more than anything that we ever get to know, and they get more financial information and they get it every month. So, and these are also essentially the same bank group that's been WeWork's bankers for years. As a banker to the company, as a personal banker to Adam Newman, the failed CEO, and even as equity investors. If anybody knew what was going on under the covers with WeWork, it was the banks, and they were spooked and they wanted out. They didn't want any part of this. That's your main clue with this. So finally in January, we hear two things, very important key pieces of information. One, only Goldman would step up and make a loan to WeWork. Number two, it would only be a letter of credit facility. So they're not going to give them a penny of cash. Number three, they would only do the deal if SoftBank agreed to come on board as a co-borrower. So that meant that they were not going to come. It's all on SoftBank to take care of this or not. It's not going to happen. And that's the best they could get. And so that was and then the second really probably bigger piece of news is that SoftBank, number one, did not have the cash to fund the tender and needed to borrow loans. And that was not expected. Number two, only SoftBank's bank said they didn't want to do it. So SoftBank was trying to borrow $2.8 billion to fund this tender offer for WeWork stock. And SoftBank's bank said, no, you are tapped out. We don't want any further exposure to this. You are overexposed. You're maxed out. We're out. That was very alarming. So that meant if SoftBank can't fund the tender, WeWork can't stand alone. That's pretty clear. And so it's no surprise that not long thereafter, WeWork hired as a new CEO a takeover or bankruptcy and turnaround specialist as a CEO, because that's really where we are with WeWork. It is insolvent. It's only not in bankruptcy because SoftBank has to realize and determine what it's going to do with WeWork itself. And now when you add into the complexion or to the situation, what's going on with WeWork, I mean, SoftBank being much weaker financially than expected, all these other things make clear. This explains why they gave themselves 4 months to fund the tender, why they needed to borrow money to fund the tender, why they can't, as the market says, well, shoot, they've got shares in Alibaba and all these other really great winners, just sell some stock. Well, if you're a lender to WeWork to SoftBank, and you're already concerned about their leverage, you don't want them to sell their winners. You want them to keep that asset package as tight as possible, because guess what? You've already got a clue there's a problem with the valuation of SoftBank's assets as they're presenting to their lenders, because they're still showing WeWork on the books as an entity worth $8 billion, and it's clearly not worth. In fact, I think the equity is worth zero and has been worth zero for a while. So if WeWork is overvalued, so there you could argue are its other assets to some degree, and that's before the market crashed and the equity. Now we're about to enter into an economic slowdown. So the rescue plan has been in trouble, and I think what we saw with the news, the signal to me is that over the last week or so, I skipped a step. SoftBank could not get funding for its tender offer, so it borrowed against its own shares with a margin loan. Now, you don't borrow against your stock, borrow against your own stock when your banks are worried about your asset value. And then step two, you don't use that cash for a stock buyback to please your activist investor. That made sense why the S&P said, whoa, wait a minute, this is irresponsible financial policy here, and their banks are probably in agreement with that. So that's where we are. So when we come to the news yesterday, that is SoftBank playing games? Are they trying to get better deal, better terms? I don't think that's necessarily true. I think SoftBank could very arguably be looking for a way out, and they could find it possibly with WeWork's dicey financials, because the S&P, the SEC and the Justice Department have been looking into WeWork's financial reporting and statements and representations to the public since last fall. And we know that they had a year of unregistered bonds outstanding, and yet somehow when they filed an S1, the market was completely surprised and shocked about their terrible operating performance and prospects versus the information that had been reported to unregistered bondholders as well as the public in the S1. So they could probably try to get some kind of, or at least go to court, because this thing, of course, I'm expected to land with lawsuits. If that happened, they could try to pull out and everybody sues everybody, but you'd have a hard time arguing they don't have good reason to be concerned about what WeWork has told them versus what has panned out as the truth. And you could also argue, if you're WeWork, hey, you've been investing with us in multiple rounds for years, you knew what you were buying. So it could get ugly, but there's nothing to be served here to benefit investors in the meantime.
Vicki, thank you. Wow, there's been a lot going on, we all know. One question that this brings to mind here is, what about lawsuits? Could WeWork sue SoftBank if it backs out?
I think they could. I think they would try to. I think that they'd have that would be your natural, backup. The thing is, though, where is WeWork going to get the money for long-term lawsuits? They can't. I think they're probably using, membership funds and customer money deposits and such to keep the lights on. So it's not like they're in the position to fund a long-term lawsuit against SoftBank, especially when their case would be, you were going to buy us out, and SoftBank will say, yes, but you didn't tell us the truth about everything. And it's hard to argue that, that they did. So, but that doesn't mean everybody won't end up in court. I fully expect that would happen. I'm just not convinced that WeWork would win.
Got it, Vicki. So I guess now that we are talking about it, what would a WeWork bankruptcy look like? How complicated would it be to unwind this business? This is a question we're receiving from Japan.
Yeah, this would be very ugly to unwind, because when I'm looking at WeWork, you see an untenable business model with revenue that's by design it can evaporate when market conditions deteriorate. That is the very appeal that its customers look at when they signed up. If things go wrong, this is a short-term agreement. I'm out of here. I can leave and go home, bring my employees home, whatever, if things go south. And here we're seeing that. And so that was already in the cards. And so you have short-term revenue that can evaporate, as you know, in broad daylight. And that's what we're seeing. At the same time, you have a high, very expensive, untenable cost structure, most of which are non-employees, most of which are costs for these expensive leases, and they have something on the order of $50 billion in long-term leases. The terms of those leases give us a clue that even the counterparties to these leases knew that they were probably dealing with risk here, because WeWork was, it habitually overpaid for leases, and it was having to make longer and longer term leases to be able to get people to sign deals with them. Now, here we are, the market has completely dried up. So WeWork didn't just break WeWork broke commercial markets wherever it was all over the world. So now we have commercial markets with excessive pricing driven by high WeWork pricing. Now you have landlords to these leases. Do they let WeWork out of these leases and then sit with empty buildings no one's going to lease? Or do they keep, WeWork on the hook, try to keep suing them and try to keep, get something out of these leases versus, but at least they can report they've got an occupied building, even if it's, they're not paying rent, the building's occupied, versus having empty buildings no one wants to lease. And frankly, this is a model. WeWork's model is not as unique as people would have it. It's commercial real estate. It's not a tech company. It never has been. It is a business model. Co-working has been around since the 60s, and a lot of people have been doing it. IWG went through this and actually went bankrupt and came back and had their business model tested by fire, and they're financially stable and profitable. This is now a shrinking market. We're entering into probably a protracted economic slowdown, if not recession, and some people are even using depression. We'll see. But this is a market that WeWork is no longer dear, and WeWork is replaceable, and no one will miss WeWork in a rapidly shrinking market. So there's no reason for it to come out of bankruptcy. There's only reason for liquidation, and we have nominal tangible assets at best, which are claimed by the secured, the handful of secured lenders involved. Most everything out there is not secured and is just, done, including $700 million in bondholders that have, I imagine that their claims are probably impaired, if maybe completely. So that wipes out equity. And that means SoftBank's got a big goose egg that it has to, standing out there, the elephant in the room, that it has to deal with. So it's not going to recoup $11 billion in equity that is thrown at WeWork, another $1.5 billion since then. But WeWork is not going to be fixed on a dime. It could take, even SoftBank finally had to admit, it would take 3 years at least to fix WeWork, if it can be fixed. I'm not convinced that it can, and I'm even less convinced that it should be.
Thanks, Vicki. I'm sort of moving on to the last two questions. Just sort of a reminder, this is a flash webinar. We can organize follow-up calls with Vicki or any other premium service request that you would want. So Vicki, a question here. This is a sort of follow-on question from the same participant. Well, are there any potential outside buyers for a distressed WeWork, according to you?
The problem would be the price that they would be willing to pay, and what would they get for their money. The biggest obstacle for WeWork is taking on these leases, because WeWork is the idea of WeWork is easily replicated. You can go do that without taking on $50 billion in leases and just a bucket full of revenue. And that's not it's not just their leases, it's WeWork's obligations. They have several hundred million on the balance sheet in, money that they collected from customers that are supposed to do these leasehold improvements for existing customers. And they haven't done that, and they're obligated to do that. That's money that they're including in their cash, but they really can't spend it. That's to spend. They've got lawsuits for failure to execute. They've got in their lease agreements, their landlords have the right to come and claim letter of credit kind of cash if they fail, or if they default on leases. So even if they don't pay, or if they default, the landlords can go after them for more cash. So they can't renegotiate leases. They can't just get out of leases without cash. There's lots of obligations. And then we've got we can have some regulatory problems here with regulators coming in and, hitting them with several hundred millions in fines. And that'll take, they have to play with that somehow. There's very little asset value because WeWork doesn't own hardly any of its properties. And what it owns, you can't attribute much value to it. So there's, you've got almost vapor is tangible asset value versus just a mountain of obligations. It doesn't make sense. Who would want to come in and buy that? You don't have to.
Vicki, thank you very much. That's all the time we have for today's Flash webinar. Very, very informative. We hope that we'll be hearing from you soon. We did receive some questions on some of your other coverage today as well, including Tesla, but we'll get to that on a different day. And again, once again, finally, to all participants, this was a Flash webinar. As a follow-up, we will be helping clients who wish to undertake any bespoke research requests or standalone assessments. Please contact your Smartkarma sales rep or account managers to discuss this further. Vicki, thank you very much. You've had a very, very long day. We'll let you get on now. And thank you everyone who joined us this morning. Bye-bye.
Thank you.